Disclaimer.
While you were watching the screen in horror as silver collapsed to $85 this Friday, the world's biggest bank was quietly standing in line to take delivery of every physical ounce they could find. They want you to believe in the $85 lie, but the $123 Shanghai reality is screaming otherwise. JPMorgan hasn't just reversed their massive short position, they have cornered the remaining 250 million ounces of the global float. The clock is ticking toward the 9 p.m. Sunday open, where the paper manipulation of the West finally hits the physical brick wall of the East. Is this a crash, or the greatest wealth transfer in history? Watch now before the $100 collision begins. Friday morning, you're watching silver hit $113.25 per ounce, thinking about that stack in your safe finally paying off. Then, by market close, you're staring at $85, a $28 bloodbath in a single session. Your first instinct? Panic. Maybe Marko Kolanovic was right. Maybe this really is crashing to $50 and you should sell everything before it gets worse. But what if I told you that brutal Friday massacre was the exact opposite of what it appeared to be? What if the same bank orchestrating that price collapse was simultaneously standing in line to take physical delivery of millions of ounces? Would you believe me if I said the biggest short seller in silver market history just executed the greatest reversal trade ever recorded, and they're now positioned to profit from the very explosion they spent a decade suppressing? Here's what you need to understand about JPMorgan Chase. For years, they've been the villain in every silver investor's story, and rightfully so. According to CFTC data analyzed by precious metals experts, JPMorgan held a paper short position exceeding 200 million ounces, the largest concentrated bet against silver in modern market history. They made billions as silver prices stayed pinned below $30 for nearly a decade, while our economy printed trillions in stimulus. Every time silver tried to break free, mysterious selling pressure emerged right at resistance levels. Retail investors blamed manipulation, but proving it was impossible because the data stayed hidden in aggregate reporting. Then something extraordinary happened between June and October of last year. JPMorgan did the impossible. They unwound that entire 200 million ounce short position without anyone noticing until it was too late. Think about the precision required to exit the largest short position in any commodity market without triggering the very price explosion you're trying to avoid. Bank of America's commodity desk estimated this liquidation should have sent silver to $80 minimum, yet prices barely moved above $32 during the entire period. How does a bank cover that much exposure in 4 months without the market noticing? The answer reveals their genius, and it should terrify anyone still thinking in old paradigms. While publicly maintaining their bearish stance through media-friendly analysts, JPMorgan's proprietary trading desk was quietly accumulating long positions through multiple channels. They weren't just covering shorts, they were building the largest long position in silver market history. According to filings examined by financial analysts, JPMorgan now controls approximately 750 million ounces through their proprietary holdings, combined with their role as custodian for the SLV Silver ETF. Let me put that in perspective. They went from being the biggest bear to the biggest bull, and most investors still think they're short. This wasn't luck or market timing. JPMorgan saw what we are about to see right now, the mathematical inevitability of $100 per ounce and the systemic breakdown waiting on the other side. They positioned themselves before retail investors, before foreign central banks, before the mining companies even understood what's coming. The bank that spent years suppressing silver prices suddenly owns more physical metal than the next 10 largest holders combined. That's not a trading position, that's cornering a market. Now here's where Friday's price massacre becomes crystal clear. Marko Kolanovic, the former JPMorgan strategist who built his reputation on market timing, goes on financial television screaming that silver is crashing to $50. He's telling you to sell, warning about deflation, predicting commodity collapse across the board. Meanwhile, what's JPMorgan's proprietary desk actually doing? They're standing for maximum physical delivery on January 2026 COMEX futures contracts. Not rolling positions forward, not settling in cash, demanding actual metal delivered to their vaults. You see the split personality here? The public face tells you to panic while the private hand grabs every available ounce. They crashed the paper price on Friday while Shanghai was closed, hoping you'd panic sell your physical coins to their dealers for pennies. But the 9% margin math says they are the ones in a trap, not you. This creates what traders call the trap, and the mathematics behind it should make every silver holder pay attention. Let me walk you through the numbers that reveal why JPMorgan positioned themselves this way. According to the Silver Institute's latest supply-demand analysis, total above-ground silver inventory that is actually available for industrial use and investment sits around 1.5 billion ounces globally. Sounds like a lot until you start subtracting what's already locked up. JPMorgan controls 750 million ounces between proprietary holdings and SLV custody. That's half the global supply in one institution's hands. The SLV Silver Trust holds 517 million ounces that can't be easily accessed by retail investors or industrial users because of the fund's redemption structure. COMEX registered silver inventory, which represents metal actually available for delivery against futures contracts, has collapsed 70% since 2020, according to CME Group's own daily reports. We went from over 300 million ounces sitting in COMEX vaults to barely 100 million today, and most of that belongs to major banks who aren't selling. Do the subtraction with me. 1.5 billion total minus 750 million controlled by JPMorgan, minus 517 million locked in SLV, minus the collapsing COMEX registered inventory equals roughly 250 million ounces of deliverable physical silver left in the entire world. That's all that remains for a market demanding 1.2 billion ounces annually, according to Metals Focus research. Industrial fabrication alone consumes over 500 million ounces per year for solar panels, electronics, medical equipment, and defense applications, none of which can substitute another metal without massive retooling costs. JPMorgan now controls the entire remaining float. Every ounce you own, every contract trading on COMEX, every industrial order from Samsung or Tesla, it all depends on that shrinking pool of available metal. And the bank that positioned themselves to profit from scarcity is the same one telling you through their former strategists that prices are crashing. You think that's coincidence? Here's what makes this trap different from normal market squeezes. In most corners, whether it's Volkswagen shares in 2008 or GameStop in 2021, short sellers can eventually find shares to cover because the underlying asset can be created or borrowed. Silver is different. You can't print more physical metal. You can't borrow it indefinitely without eventually returning actual ounces. Mining companies can't just dig faster. Primary silver production actually declined last year despite prices rising because most silver comes as a byproduct of copper, lead, and zinc mining. When those base metals struggle, silver output falls regardless of silver prices. This means JPMorgan saw something the rest of the market missed. They recognized that paper silver contracts, the futures and options traded on COMEX that have dominated price discovery for 50 years, were about to collide with physical reality. For decades, the paper market traded at 50 to 100 times the size of actual physical silver available for delivery. Everyone assumed the system worked because most contracts settled in cash or rolled forward to the next month. Banks could create infinite synthetic supply through derivatives, while physical supply stayed relatively fixed. But what happens when industrial demand keeps growing, above-ground inventory keeps shrinking, and suddenly everyone wants physical delivery instead of cash settlement? JPMorgan answered that question by switching sides. They're no longer betting against silver. They're positioned to profit when the paper market finally breaks and physical premiums explode. Friday's price smash wasn't capitulation. It was accumulation at discount prices before Monday night's Asian markets open, and the real action begins. Think about your own silver holdings right now. Whether you have got American Eagles in a safe or shares of a silver miner in your retirement account, you're about to find out if you own real exposure or just paper promises. JPMorgan already answered that question for themselves by demanding physical delivery. The trap is set, the float is cornered, and the clock is ticking toward a collision that's been building for over a decade. The only question remaining is whether you understand what's happening before it's too late to position yourself on the right side of history's greatest commodity squeeze. What happens when the Chicago Mercantile Exchange panics so hard they rewrite margin rules that have worked for decades? You get a doomsday formula that makes $100 per ounce not just likely, but mathematically guaranteed. And the most fascinating part? The people who created this rule change are the same ones now trapped by it. On January 13th, the CME Group made a decision that will go down in financial history as either brilliant risk management or the catalyst for the biggest commodity default since the Hunt brothers tried cornering silver in 1980. They switched silver futures from fixed dollar margin requirements to a 9% percentage-based system. Sounds technical and boring, right? Let me show you why this single rule change just weaponized every dollar of price movement into a margin call apocalypse. Here's how margins worked for years in our silver market. You wanted to trade one futures contract representing 5,000 ounces of silver? You posted a fixed amount, let's say $4,500, regardless of whether silver was trading at $20 or $80 per ounce. The margin stayed constant, which meant traders could plan their capital requirements, and banks could model their risk exposure without worrying about price volatility, creating unexpected cash demands. It was predictable, stable, and it worked fine when silver traded in a tight range between $15 and $30. But we're not in that world anymore. Silver hit $113 on Friday morning before the massacre, and suddenly those fixed margins looked dangerously inadequate to the CME's risk committee. A $5,000 margin on a contract worth over $500,000? That's less than 1% coverage. If silver moved $10 against a trader's position, they'd lose $50,000 while only having $5,000 posted. The exchange realized they were sitting on a systemic risk bomb that could bankrupt clearing members if prices kept surging, so they implemented the 9% rule. Now, every single contract requires margin equal to 9% of the total contract value. Do the math with me on what this means at current prices. Silver at $85 times 5,000 ounces per contract equals $425,000 in total exposure. 9% of that is $38,250 in required margin per contract. You used to need $4,500. Now you need $38,000. That's an eightfold increase in capital requirements overnight. But here's where it gets truly devastating. That 9% recalculates with every dollar move in silver. When silver goes from $85 to $86, your contract value increases to $430,000, and your margin requirement jumps to $38,700. You need to post an additional $450 per contract immediately, or your broker force liquidates your position. Every single dollar of movement now requires $450 in fresh margin capital. Think about what happens as we approach $100 per ounce. You're holding a short position because you're a bank that sold silver at $70, expecting prices to fall. Silver hits $90 and you're already hurting. Then it touches $95 and your margin calls are piling up. At $100, each of your contracts requires $45,000 in posted margin. That is 5,000 ounces times $100 times 9%. You've gone from needing $4,500 per contract under the old system to needing $45,000 under the new one. And every tick higher demands more cash immediately. Now scale this to the actual size of the short position in our silver market. According to the December 2nd Commitment of Traders report from the CFTC, commercial traders, primarily banks and trading firms, held a net short position of 212 million ounces. That represents 42,400 contracts at 5,000 ounces each. Let us calculate what the jump from $85 to $100 means for these short sellers under the 9% margin rule. At $85, those 42,000 contracts require $1.62 billion in posted margin. At $100, that same position requires $1.89 billion in margin. The difference? $270 million in additional capital that must be posted immediately when silver crosses 100, or positions get liquidated. But here's the problem. Where do banks find $270 million in cash on a Sunday night when Asian markets are opening and prices are gapping higher? The answer is they can't, which means they have three options. First, they can post the additional margin and hold their short positions, hoping silver falls back below 100 so margin requirements decrease. But that requires having hundreds of millions in available cash sitting idle, and most trading desks operate on leverage. They don't keep that kind of capital uncommitted. Second, they can try to cover their shorts by buying silver contracts to close positions. But there's a mathematical problem with this option that makes it almost impossible. Remember that COMEX registered inventory number we discussed earlier? It's sitting at roughly 60 million ounces according to the latest CME vault reports. That's the physical silver actually available for delivery against futures contracts. The total value of that registered inventory at $85 is about $5.1 billion. Now compare that to the margin requirements for the short position at $100, $1.89 billion. The margin calls alone represent 37% of the total value of available physical silver in COMEX vaults. Here's where the math becomes impossible. If short sellers try to cover their 212 million ounce position by buying contracts and taking delivery of physical metal, they need to find 212 million ounces. But COMEX only has 60 million ounces registered for delivery. Even if they could access every single ounce, which they can't because some of that metal belongs to long holders who won't sell, they're short 152 million ounces with no physical metal available to buy. It's like being forced to return a borrowed car, but there are only enough cars in the entire city for 28% of borrowers. The other 72% are just out of luck. This creates what mathematicians call a reflexive loop. Short sellers need to buy silver to cover positions and reduce margin requirements, but buying pressure drives prices higher. Higher prices increase margin requirements even more through the 9% rule. Increased margin requirements force more short covering. More covering pushes prices higher still. The loop feeds on itself until something breaks. Either prices go parabolic as shorts scramble for any available ounce regardless of cost, or the exchange steps in to halt trading and impose cash settlement. Let me put this in terms of your retirement account. Imagine you're managing risk for a major bank's commodity desk, and you're short 10,000 contracts of silver because you genuinely believed industrial demand would crater in a recession. You put on that position at $70, posting the required margin, and your model showed a profit target of $50. Then silver started climbing. $80, $90. Your losses are mounting, but you're a big bank. You can handle it. Then the CME implements 9% margins, and suddenly you need to post $50 million in additional capital just to maintain your position overnight. Do you have $50 million sitting in cash? Or do you start liquidating other positions, selling stocks, dumping bonds, scrambling to meet margin calls? Now multiply that scenario across dozens of banks and trading firms. JPMorgan saw this coming, which is why they closed their short position and flipped long before the 9% rule took effect. But plenty of other institutions didn't reposition in time. According to the Bank for International Settlement's latest derivatives report, silver derivatives exposure across global banks exceeds $200 billion notional value. Even a small percentage of that in distressed positions creates systemic risk. The timeline makes this even more urgent. JPMorgan's 3-month silver lease with Industrial and Commercial Bank of China expires in January 2026, meaning they borrowed physical silver from ICBC 3 months ago and must return actual ounces this month. India's import requirements are stacking up after delayed orders, with dealers demanding approximately 2,000 tons of physical delivery according to Reuters Commodity Desk reporting. That's roughly 64 million ounces hitting the market, as demand at exactly the wrong time for anyone short. Then there's the Bloomberg Commodity Index rebalancing that already executed on Friday. Bloomberg's index algorithms sold $6.8 billion worth of silver positions as part of their regular reweighting process. That selling pressure contributed to Friday's price collapse from $113 to $85. But here's what most people missed. That was mechanical selling from index funds, not fundamental bearishness. The silver didn't disappear from industrial demand or investor preference. It simply moved from index portfolios to other buyers, many of whom demanded physical delivery rather than rolling paper contracts forward. Structural deficit keeps getting mentioned in silver analysis, but let's be specific about what that means. According to the Silver Institute's World Silver Survey, industrial fabrication, jewelry manufacturing, silverware production, and investment demand totaled 1.2 billion ounces in the most recent year. Mine production plus recycling supplied roughly 1 billion ounces. That's a 200 million ounce annual deficit between what the world wants and what we can produce. This isn't a one-year blip. It's the 6th consecutive year of supply deficits. Every year, above-ground inventory shrinks by another 200 million ounces, as industry consumes silver faster than miners can dig it up. You know what happens when inventory keeps shrinking while demand keeps growing? Prices rise until demand destruction occurs. Industrial users find substitutes or reduce consumption. But silver is uniquely resistant to demand destruction because it's critical for technologies we can't easily replace. Solar panels need silver for electrical conductivity. Medical equipment relies on silver's antimicrobial properties. Electronics manufacturing uses silver in virtually every smartphone, computer, and vehicle. Defense contractors need silver for missile guidance systems and communications equipment. None of these applications can quickly switch to alternatives without years of research and billions in retooling costs. So we're heading into Monday night's Asian market open with every pressure point converging simultaneously. The 9% margin rule forces cash posting on every dollar move higher. Short sellers need to cover 212 million ounces with only 60 million available for delivery. JPMorgan must return borrowed silver to ICBC while controlling the remaining float. India needs 64 million ounces delivered immediately. Structural deficits keep draining inventory by 200 million ounces annually. And industrial demand can't be reduced without crippling the technology sector. There's a moment in every financial crisis when institutions realize they can't win by playing within the rules, so they change the rules entirely. We saw it in 2008 when money market funds broke the buck, and the government rewrote redemption requirements overnight. We saw it in 2020 when oil futures went negative and exchanges scrambled to adjust settlement mechanisms. Now we're about to see it in the silver market. And this time the rule change won't save the exchange. It will destroy it. Cash settlement is the nuclear option in commodity futures markets. Here's how it works in plain language. You bought a silver futures contract expecting to take delivery of 5,000 ounces of physical metal. The exchange promised you could either sell that contract before expiration or stand for delivery and receive actual silver bars in an approved vault. That's the fundamental promise underlying every commodity futures market. The contracts are backed by deliverable physical product, which is why futures prices track physical prices. But what happens when the exchange can't deliver the metal? They declare force majeure, invoke cash settlement clauses buried in the contract terms, and pay you in dollars at whatever price they decide is fair, based on the COMEX settlement price. Let me be crystal clear about what this means for anyone holding silver futures contracts expecting delivery. The exchange tells you they're settling your contract at $85 per ounce, the official COMEX closing price from Friday's massacre. You get $425,000 deposited in your account for your 5,000 ounce contract. Congratulations, you just got paid. Except there's a problem. Physical silver in Shanghai is trading at $123 per ounce. In Dubai, dealers are asking $130 for immediate delivery. In Tokyo, the premium is 53% above COMEX prices for 1,000 ounce bars. So while you received $85 per ounce in cash settlement, the actual market price for physical metal, the price you'd pay if you wanted to buy silver coins or bars today, is 50 to 60% higher. You just learned that 150 years of COMEX price discovery was fraudulent. The exchange claimed their futures prices represented the true market value of silver because contracts were backed by deliverable physical metal. But the moment they can't deliver metal and force cash settlement at manipulated paper prices, while physical silver trades at massive premiums, they've admitted the whole system was a lie. The COMEX price was not real. It was just a number on a screen controlled by banks who could create infinite paper contracts without owning the actual metal to back them. This doesn't just destroy credibility for silver futures. Every commodity traded on COMEX suddenly becomes suspect. Gold contracts representing hundreds of billions in notional value. If COMEX can't deliver silver, why would anyone trust their gold delivery promises? Copper futures used by manufacturers to hedge production costs? How do you plan your business when the exchange might force cash settlement at artificial prices that don't reflect physical market reality? Platinum, palladium, aluminum? Every industrial metal contract on COMEX becomes questionable the moment they invoke cash settlement on silver. The evidence suggests they're already preparing for this outcome. Start with the U.S. Mint's announcement that they suspended silver coin sales to review pricing structures. The official statement claimed they needed to assess premiums and manufacturing costs. But think about the timing. Silver prices are at multi-decade highs, demand for American Eagles is at record levels according to coin dealer reports, and the Mint chooses now to halt sales? They're not reviewing pricing. They're preserving their silver inventory because they know what's coming, and they don't want to sell at today's prices when cash settlement pushes physical premiums to $200 per ounce next month. Then look at what happened in India's silver trading sector. Multiple trading firms with combined exposure exceeding $425 million declared insolvency in the past month, according to Indian financial press reporting. These weren't small speculators or amateur traders. These were established firms that provided liquidity to India's massive silver jewelry and industrial sectors. What caused simultaneous insolvency across firms that survived previous volatility cycles? Forced liquidations from margin, calls they couldn't meet, followed by settlement at COMEX prices that didn't reflect the physical premiums they needed to cover their obligations. COMEX open interest tells the real story if you know how to read it. Open interest represents the total number of outstanding futures contracts that haven't been closed or delivered. According to the CME Group's latest data, open interest in silver futures currently represents approximately 460 million ounces. Meanwhile, registered silver inventory, metal actually available for delivery, sits at 60 million ounces. Do the division. Open interest exceeds registered inventory by 244%. Said differently, if just 41% of contract holders demand physical delivery, COMEX runs out of silver completely. But the actual situation is worse because some of that registered inventory belongs to JPMorgan and other major holders who aren't selling. This means 144% of current contract holders cannot get physical metal even if they wanted to. The exchange is running a fractional reserve system where they have sold promises to deliver silver they do not actually possess. It's the exact same structure that caused bank runs throughout history. Issue more claims than you have assets backing them. Then hope not everyone asks for their money at the same time. Except this time, everyone is asking simultaneously because the 9% margin rule is forcing position closures, and industrial users desperately need physical metal for production. Remember when CME shut down silver trading in December, claiming a cooling system failure required emergency maintenance? That's the excuse they gave publicly. But exchanges have redundant power systems, backup facilities, and disaster recovery protocols specifically designed to prevent single points of failure. A cooling system issue wouldn't shut down electronic trading for 6 hours during peak Asian market hours unless something else was happening. That was a dress rehearsal for what's coming, testing how markets react to a sudden silver trading halt, how quickly they could communicate with clearing members, how media would cover an unexpected closure. They were practicing for the day they invoke cash settlement. Friday's price action revealed the final piece of evidence that cash settlement is inevitable. Silver dropped from $113 to $85 in a single session, a $28 collapse that would normally trigger massive physical buying as dealers and investors rushed to purchase at discount prices. Except the physical premiums didn't budge. Even at $85 COMEX prices, dealers in Shanghai maintained $123 ask prices. Physical silver in retail markets stayed at $130 for American Eagles. The premium held at 53% above paper prices throughout Friday's entire crash. What does that tell you? The paper market and physical market have completely decoupled. When COMEX prices fall, physical prices stay elevated because actual silver owners know the paper price is artificial and they refuse to sell at manipulated levels. When COMEX prices rise, physical prices rise even faster because buyers understand paper contracts might not deliver and they're willing to pay hefty premiums for guaranteed metal. The two markets no longer track each other, which means price discovery has failed. And when price discovery fails in a commodity futures market, the exchange has lost its fundamental purpose. Here's the final calculation that proves cash settlement is the only option banks have left. Short sellers need to cover 212 million ounces based on CFTC data we discussed earlier. COMEX has 60 million ounces of registered inventory available for delivery. Even if short sellers could access every ounce, which they can't, they're short 152 million ounces with nowhere to buy it. So let's examine their three options and why only one is viable. Option 1, cover the entire short position by buying silver contracts and taking physical delivery. Impossible. The metal doesn't exist in COMEX vaults in sufficient quantity. Even if they bought every available ounce at any price, they'd still be short 152 million ounces. This option leads to default. Option 2, hold short positions and post the required margin as prices rise toward $100 and beyond. At $100, those 42,000 contracts need $1.89 billion in margin. At $150, where physical premiums suggest prices are heading once COMEX credibility collapses, margin requirements hit $2.84 billion. At $200, we're talking $3.78 billion in posted margin for positions that are already losing billions on mark-to-market. Banks would need to liquidate other portfolio holdings, sell stocks and bonds, potentially triggering broader market instability just to maintain losing silver positions. This option leads to bankruptcy. Option 3, exchange declares force majeure, invokes cash settlement at $85 COMEX prices, and pays out all contract holders in dollars rather than metal. Short sellers close positions at $85 even while physical silver trades at $130 in real markets. The banks survive. The exchange survives. But COMEX as a credible commodity futures market dies permanently because everyone now knows the contracts aren't backed by deliverable metal. You can see why option 3 is the only viable choice from the exchange's perspective. They can't deliver metal that doesn't exist. They can't allow margin requirements to bankrupt major clearing members. So they'll invoke cash settlement, claim it's necessary to maintain orderly markets, and hope the financial media doesn't explain to viewers that they just admitted 50 years of price manipulation. But here's what makes this different from previous commodity squeezes or exchange interventions. When the London Metal Exchange forced cash settlement on nickel contracts in 2022, after prices spiked to $100,000 per ton, it was a temporary crisis affecting a relatively small market. Physical nickel remained available. The issue was extreme price volatility from a short squeeze. The LME could plausibly claim they were preventing market manipulation and protecting price integrity. COMEX can't make that argument for silver because physical premiums prove the paper price is the manipulation. When Shanghai trades silver at 45% premiums to COMEX, when Dubai dealers charge 53% more than futures prices, when American Eagle coins sell for 60% above spot, the entire world is screaming that COMEX prices are fraudulent. Cash settlement won't preserve market integrity. It will confirm that paper silver markets were a scam designed to suppress prices and benefit short sellers at the expense of industrial users and investors. Think about your position right now. If you own physical silver coins or bars in your possession, cash settlement doesn't affect you. Your silver is your silver. When COMEX fails to deliver and physical premiums explode to $150 or $200, you own an asset that just appreciated massively while paper contract holders got cashed out at $85. If you own silver mining stocks, you're holding companies whose product just became vastly more valuable as physical prices decouple from paper prices. If you own SLV or other silver ETFs backed by physical metal, you're in decent shape as long as the fund actually holds the silver it claims, though you'll want to verify that after COMEX's failure raises questions about all silver custodians. But if you're holding paper futures contracts expecting to take delivery, or if you own derivatives and options based on COMEX settlement prices, you're about to learn an expensive lesson about counterparty risk. When the exchange can't deliver physical metal, your contract becomes worthless, regardless of what silver is actually worth. You might get $85 per ounce in cash settlement while watching physical silver trade at double that price, and there's nothing you can do about it because the exchange controls the settlement terms. This is why JPMorgan flipped from short to long, and why they're demanding physical delivery rather than holding paper positions. They understood that the paper market was approaching its mathematical endpoint, where claims exceed deliverable supply by orders of magnitude. They positioned themselves on the physical side of the divide before retail investors and smaller institutions figured out what was happening. Now they control 750 million ounces of actual metal, while everyone else fights over the remaining scraps or gets cashed out at manipulated prices. The Sunday night opening of Asian markets at 9 p.m. Eastern represents the moment of truth. Shanghai traders will bid for silver based on physical market conditions, structural deficits, industrial demand, central bank buying. They won't care about Friday's paper price crash because they're buying actual metal for delivery to manufacturers and investors. If their bids open significantly above $85, which seems likely given current physical premiums, the gap between paper and physical prices becomes undeniable. COMEX will face a choice: allow silver futures to gap higher and trigger the margin call cascade we discussed, or halt trading and prepare for cash settlement. Either way, the outcome is the same. The paper silver market that controlled price discovery for over a century is ending. Physical silver will trade at prices determined by actual supply and demand, rather than bank manipulation through infinite paper contracts. Industrial users will pay real market prices for the metal they need. Investors who own physical silver will see the value of their holdings reflect genuine scarcity. And everyone who believed silver was worth $85 because COMEX said so will understand they were watching a fiction created by institutions that could create supply on paper but could not produce metal in reality. You're witnessing the final days of a system that allowed banks to control commodity prices through derivatives and leverage, rather than actual ownership of physical assets. Cash settlement isn't COMEX admitting temporary problems. It's COMEX admitting their entire price discovery mechanism was fraudulent. The exchange won't survive this revelation with credibility intact. The banks who profited from paper manipulation for decades won't avoid the consequences when industrial users and investors demand answers. And most importantly, you now understand why owning physical silver in your possession is the only position that guarantees you're on the right side of history's greatest commodity market collapse. The collision is here. The question is whether you're holding real metal or paper promises when the exchange admits they can't tell the difference anymore. The $100 collision isn't just a number on a screen, it's the moment the paper lie dies and physical reality takes over. Tonight at 9 p.m., when the Asian markets open, we will see if the COMEX survives or if the cash settlement trap finally snaps shut. I've laid out the math, the margin calls, and the JPMorgan flip. Now the choice is yours. Are you going to hold on to paper promises, or are you going to stand on the side of physical metal?